Hey guys, don't forget to subscribe, like, and hit the notification bell for more. Okay, guys, it's Kevin and Patrick from NorthStarBadCharts.com, and it's our absolute honor, to welcome back Michael Oliver from MSA.com. Michael, how are you doing?
I'm doing great. Hope you guys are too.
Good stuff.
Thanks.
Good stuff. Well, it's always great to have you on the show, Michael, because you give us a different perspective on the markets, and the momentum structural analysis is something that some people will be familiar with, but I think many will be
Mhm.
looking at this from with fresh eyes. So it'd be great to have you talking us through what you're seeing in the markets. Things have been pretty interesting just recently. The stock market's very strong. Precious metals also pretty strong. Whether or not they are reaching those critical breakout levels is a little bit debatable. We're just at that point, aren't we, where it starts to become clear what's happening with the precious metals and lots of other markets as well. Also at some critical points, things like cryptocurrencies and so on. So many markets are at sort of decision points at the moment. So how are you seeing things at the moment, Michael?
Well, we turned major bearish on the U.S. stock market in January 2022. Okay. Now, it dropped pretty severely after that into the summer and then in the fall, made a low in October finally. And then we had the recovery rally in the S&P up to the July highs. Okay. NASDAQ as well. They didn't go back and make a new high. Then they pulled back down recently, didn't make a new low, and then turned around again. And now, because of the Fed rally, it's a party. Everybody's blowing whistles and putting hats on.
You've sent me some charts as well, actually, Michael. Do you want me to share those whilst you're talking?
Yeah, put those
Yeah,
up. Yeah,
I'll do that. Yeah.
Archival charts here, because what's going on now is deja vu for us. We've been around since the 1990s. Okay, and in 2000 we called the top. In January of 2000, that was the end of the dot-com bubble. What you see there is the S&P 500 monthly bar chart, and below it is each monthly close of the S&P. It's a momentum chart down below it. We plot the close and its relationship to, in other words, how much above, how much below the 3-year moving average. And as you can see, all during the bull trend on the top chart, that 3-year average is well below the market. Okay, you look at the momentum chart, there was a topping pattern that developed from 1996 through early 2000, where you kept dropping to almost a flat line, gradually rising. You kept hitting it. There's like 4 or 5 hits along that line, spanning 4 years. January of 2000 blew that structure out. Okay. Therefore, the momentum said, I'm through. Now, the problem was when in our report we issued in the first days of January 2000, was we said, okay, get out, it's the top. But we also cautioned, watch out, it could be laborious, because there were certain other technical factors that looked like they needed to spin their wheels for a while. They weren't quite as ripe as annual momentum said, okay, I'm through. But some other indicators said, no, I'm going to hang around a while. Okay. And they did. Let's go back, talk about the Fed back then. This is part of the deja vu. The Fed had been raising rates up until May, a couple of months after we said sell, of 2000. It was the final rate rise occurred in May. We said sell. Okay. Now you'll notice that the red arrow on the top chart, which shows where price was when we said sell, just below 1500. That's when it broke the structure on the momentum chart. There was a sharp drop into February, and then you turned around in March and made a new high. Marginal new high. It felt good though, price guys. Now look at the momentum chart and look at the rallies in 2000, how they looked on momentum compared to the seemingly robust price action on the price chart. So the price chart kept making new highs. In fact, in August, 1 month after the Fed put out a July statement, the month of July, the top monthly close above 1500 over to your right a little bit later in the year, not there, a little further. That top close there, that's August. Okay. In July, late July, they put out a report, monetary report, and they threw out enough terminology to say, hey, things are mellowing a bit. So the strength that we've seen before, we're starting to see it mellow, meaning they were hinting in their typical subtle way that they're not going to raise rates anymore. Because so what happened? The market rallied sharply in late July into that August close. In other words, if you'd have sold that softening terminology by the Fed, after a couple of years of rate rises, they basically admitted, okay, you know, things are softening up. You sold the top. Now, a lot of people were buying that news because, oh boy, the Fed's going to quit raising rates. Okay. Anyway, it started back down, and it wasn't until January, a handful of months after that peak close, that you really started to break the market down. That's when the Fed started aggressively cutting rates, well before the market was really collapsing. But they had an emergency meeting, and in the first days of January, they cut rates by half a basis point. They cut rates all the way down. So if you're buying the stock market today, because it made a new high on the NASDAQ today, intraday, okay, finally. It's much like what happened in 2000 when, after we said sell based on annual momentum breakage, which we put an emphasis on, not so much price. Price actually kept beating its chest, but really didn't go on its wheels, but it felt good. In fact, there was a term that was in the Wall Street Journal by a well-known CNBC talking head today, who was writing an article back then in 2000, used the word soft landing. It's not a new term. Okay. Anyway, so stock, and that's the current NASDAQ chart. Look at it. Page. This is the same type of chart. This is a price chart of the NASDAQ from the 2009 bear low to present, and an annual momentum chart below. But anyway, we're having the same type of stuff now. We said sell in January of 2000. That's when the market basically broke back under 16,000. It peaked intra-month in late 2021 in price. Okay. After that, it stopped. That it's peaking, it's over. So if you exited then, well, you're now kissing your sister, okay? It's back to where you sold it, but you haven't missed anything, okay? You've missed a lot of pain in between. But this is doing now the same type of thing it did back in the summer of 2000, which is to say, the party's on because the Fed is now going to soften. We all know that. Not only did they say they're going to cease, but they even said we're cutting next year sometime, okay? Now, the only debate among analysts is when will they cut? Okay, so it's not whether, when, okay. But anyway, the market rallied to a marginal new high today, actually, just before we turn the cameras on. But look at the annual momentum picture since that there's two arrows we have there. The first arrow was an abort signal, meaning there was a prior ceiling, that the blow-off phase of the market, which is that 2021 extreme upside in price. That's what we call a blow-off, meaning a market's already old. It was like 10, 11 years old in terms of its price advance, and it went into an accelerated phase. Usually when a market does that on price, and it's been going up for a decade and then goes vertical, that's usually terminal, meaning it's exhausting itself. So when you have an abort, and momentum clearly signaled that at the first arrow, that was in January. A few months later, it broke the major parallel uptrend channel that went all the way back to the 2009 lows. Now, if you plotted on price back to the 2009 lows, you couldn't get a trend line. It's an upward curve, okay? But momentum, a parallel channel defined by 5 peak monthly closes and 3 pivotal low monthly closes, which you broke in January of 2022, okay? Now, look at price. It's impressive, right? Oh, it looks great. Look at momentum. It's up underneath the channel, bumping its head. Now, that circled momentum reading there is not where it is now. That's where it's going to open. If you close this month, where you are right now in price, which is to say at the highs, when you open next month, that's where the momentum chart's going to be showing where it is. There was a hard downtick. Why? Because the 3-year average is rising. But in terms of momentum trend structure, this is as broken as they get. Now, that doesn't mean you can't have the rally we had. We argued back when it broke early 2022 that it's likely to be arm wrestling, much like the 2000 top was. The only difference is it's more protracted. It's 2 years wide now, basically. And that makes sense because even the 2000 bull market is only, like for the S&P, a triple for NASDAQ than that, but it was the bull market only stock market peak in terms of the dimensionality and duration, 2000 peak, the 2007 peak. You can't find a bull that was so inflated as this one. If you look at an M2 chart during all that dozen years, you'll know why. Look at a Fed funds chart for that dozen years, you'll know why. It got printed higher. Now, the question is, what's going to happen? Well, we're momentum people, and we say, no, this beast is broken. Don't trust the rally. And so the question is, of course, what happens when this paper asset bubble doesn't oops like it did in 2000 or did in late 2007? Fed had been raising rates up through 2006. In September, mid to late September 2007, the S&P was in the mid 1500s. They cut rates by 0.5 basis point. You had a 4 to 5 week surge in the market to a new high. This is S&P now. Most indices like financials and so forth weren't making new highs, but the S&P was making a new high then in October of 2007. If you sold that rate cut, sharp 0.5% rate cut, September 2007, you basically sold the top. And they continued to cut rates all the way down through 2009, and the market back then collapsed just like it did in 2001 and 2. So buying the stock market when the Fed shifts policy to a softening policy, they have a reason for that, and it's not good. In other words, they're panicked by something. And I think what it is the crash we just had in the T-bond market. I think that spooked the hell out of the central bank. So anyway, that's where I think we are. I think we're basically...
I was going to say, Michael, there's another indicator as well that I've been keeping close eye on. This is, pretty sort of running in parallel with the yield curve inversion, of course. The 10-year yield minus the 2-year yield, as an example, is very much inverted. And historically speaking, when that situation normalizes and the yield curve begins to uninvert itself, then the markets tend not to like that very much, to put it mildly, as well. And we tend to get some kind of major economic financial event of some sort. So what you're describing there, if that happens to take place at the same time as the yield curve uninverting and another number of other indicators as well, it kind of adds to that sort of picture, that jigsaw puzzle, increases the confidence, doesn't it, that something pretty unpleasant is heading our way next year.
Yeah, well, they can't, a year ago, October 2023, the T-bond market had a very sharp sell-off. Okay. It wasn't a crash, but it was definitely a sharp sell-off. It had been going, we could turn bearish on bonds in October 2020. Okay. But in late last year, there was a very sharp sort of tail end to that bear market. It actually wasn't the tail end. We forecasted it would have a nice bounce, but it wouldn't sustain. And it bounced from the October low last year up to a nice rally high, stabilized, stalled early this year, and then rolled back over. In the summer, we said, oh, there's going to be a nuke event here, technically. We blew out the October lows of 2023. But if you go back then and listen to what Janet Yellen said in press conferences, she was expressing extreme distress at, quote, the illiquidity in the U.S. T-bond market. Okay, when we crashed this summer, the T-bonds, and if you look at the price chart of T-bonds this summer into October low, compared to last October sell-off, it was crash this time around. And yet other bond markets at the same time, like let's say muni bonds or high yield corporate debt bonds, they weren't behaving like the US government bonds were. They weren't in crash mode. T-bonds were crashing, and you know that they must have been really panicked. Yellen did not open her mouth during the recent drop, because if she did, it would have indicated serious panic. And I know good and well that in September and October of this year, as the bonds were literally collapsing, looked like some commodity, they had to be in there in the dark supporting that market. And so we did get the V-bottom low that we expected in the T-bonds. It's not going to sustain, but it definitely has turned heads. And now it sort of fits with the psychology of the stock market buyer who said, oh, great, the Fed's going to soften, and therefore it's good for the stock market. No, it's not. Because the reasons the Fed is going to soften are panic reasons, which they don't express. But when their T-bond market collapses, and that's not part of their incremental policy changes, that was out of control. And so you know good and well that their key market, when it starts behaving like Japanese government bonds, they got to be panicked.
Yeah, and
And
that's something that's important to realize. I think certainly looking back through the charts myself, that historically there are occasions when the stock market does well following a sort of a pivot and rate reductions, and there are times when the stock market does spectacularly badly when the Fed changes its policy like that. And to my mind, that comes down to that backdrop. Why are they reducing interest rates? What's been going on in the recent past, and how is the rest of the market shaping up? And if you can look at the evidence and see that there's a problem and identify that they're cutting rates because of a problem, and that it's effectively really cutting rates for a bad reason, not a good reason, then that kind of adds that weight to the hypothesis that stock markets are, as you say, extended, exhausted, running on borrowed time. And I think that's important for people to understand, because you can't look at a chart in a vacuum. You can't just look at a single chart and say, well, because this is happening, then it means that's going to happen. You have to set it in context. It's like anything else in life, I think, isn't it, Michael? You know, if you don't consider the context, then you're liable to draw the wrong conclusion. So that is it. It's a very important point that you made there.
Well, also what we're looking at now, not shown on these charts, is how do you define when this rally ends? In other words, you can wait till it comes and takes out the lows of 2022 if you want. That's no good. You know, it's too late. There's a lot of metrics that tell us, for example, and we don't have the S&P chart here, the current one, but S&P right now is 4750 area. Okay, it hasn't made a new high yet, but it might. Who knows? And remember, it's the S&P 5, not the 500. Okay, Apple, Amazon, Microsoft, Tesla, and they explain the entire movement of the index. So if you want to call it an index. I would say ballpark, and now we define these numbers very specifically in our reports, but you get into the first quarter of next year, and if you pull this market back, let's say to 4,400, and that number could adjust up a bit depending on what happens in the next week or so. In the first quarter or anytime next year, you got a problem. In other words, I don't care if you make a new high or not. You drop back down to that level, and we've got some triggers that will be elected that say, okay, this recovery effort is over. We're headed back to take out the lows. So what we're trying to define now is not whether the market's broken. In our assessment, it's broken, despite the recent rally. Just like the 2000 secondary rally, the 2007 new high based on Fed stuff. But there's a level not far below, and that's, we're talking 350 points. That's single-digit % drop to get there. And I think at that point, if you're still a believer in the stock market, you better rethink. And obviously now, what happens if that occurs? Well, data points that everybody likes to point to, like the Fed and so forth, unemployment, industrial production, whatever, you name it. They like to debate about this decimal or that decimal in some data point. Those data points always follow the market. They don't lead the market into bear trends. You go back and look at the top in 2000 or 2007, and then go overlay like any econometric you want to put in there that's very popular. They were very lagged to the downturn. You might have had a little bit of softening, but really they didn't say this is no good anymore until the stock market said it's no good anymore. So anybody waiting on that is going to be left out. And the Fed's watching that stuff, and they're probably ahead of the game a bit in terms of their interpretation. Okay, well, what does that benefit? Well, Jeff Gundlach, a few days ago after the Fed meeting, made a comment on TV, which I fully agree with, and they're going to monetize again. They got to. They got to go to panic mode. Well, monetary metals. That's why gold has been hanging around so tough. Despite the, quote, Fed fighting inflation, how come gold keeps going back to its all-time highs? Name me markets in the world that are going back to their all-time highs again. S&P only now did, but gold's been doing it for a couple of years. Now, here we got some price charts, just simple price charts. Our momentum charts of gold and silver already turned bullish long time ago. In February 2016, based on annual momentum of gold, we turned bullish. Those charts aren't shown here. Nothing has changed in our mind over that last 8 years to alter the annual momentum trend of gold. So we look at more shorter term stuff like monthly action, weekly action. Now we had that correction in from the highs of early this year, above 2000, all the way to October. Okay. But it was an arm wrestling struggle. It wasn't a collapse. See those other highs above 2000, they're around the 2000 level back in 2020, and the other high in March of 2022. And they actually got over 2000 intra-week. These are weekly closes. So even though we took it out early this year on a weekly closing basis, intra-week, we didn't take out those highs. Those highs were 2070, 2080. We got up to those same levels. So we didn't actually exceed the intra-week highs. But then we had this yet again, the sellers up there over 2000 doing the game again. But look at the downside, how it looked compared to the downside that followed the two prior peaks. They were pretty dramatic. They didn't fool around. This time we spent all those months declining in an arm wrestling manner. And when it turned and we got a buy signal about 40 points off the low, gold got to the 1820s, I think in October. In the 1860s, I think their number was 1864, we said, okay, it's over, going up. And when they went through that level, boom, you not only went back to the highs above 2000, but intraday, in the night electronic trading of December 3rd, Sunday night, massive amount of buy triggers were elected when we hit 2100 intraday, intranight. Illiquid time of day. And there must have been, well, there was, we can look back at the data. There were like 48,000 contracts traded in about 45 minutes during one of those hours. And when you hit 2100 in gold and hit the buy triggers, you know, that an embedded short would have said, okay, I don't want to see 2100. We've always peaked just short. So he had a buy stop there. And then also some late gold joiner joined in at 2100 thinking, oh boy, you know, a little bit late, I would say. But anyway, so it rushed to 2150 in literally 15 to 20 minutes. Wow. You had so many buy orders, it was like a vacuum. Okay. Now, I understand that the Bank of International Settlements came in the dark at the 2150 area and sold dump gold. Well, when they sold, you know what was below? Nothing. Because you had just vacuumed out all the buy orders in a whoosh. Probably more so than any history point in gold, where you had more buy orders elected. So when you could have probably sold 10 contracts and watch it go down hard, because all the buy orders had just been blown. So there was like a vacuum below. So it dropped from 2100 back under 2100, and people said, "Oh my God, it's a trap." We dropped back under 2000. You don't see it there. That sharp drop is above the red line. Those are weekly closes. So intra-week, 2 weeks ago, we did get back under 2000 by a little bit. But we closed the week out, I think, at 2020 or 30, and now we're 2050. So on a weekly close only basis, what you're seeing now is action above the prior three structures that were around the 2000 level on weekly closes. So even the price chart lagged the momentum is saying, yep, I broke out. Yes, I pull back, but I'm hanging in there. Now, during the same period of time, that couple years since the 2000 peak, and actually for silver, it made its high in 2021 above 30 intraday, intra-month. But its high closes back then were around 28, mid-2000, and also in May of 2021. And then silver, rather than going more or less sideways like gold did, entered a parallel downtrend channel. It was losing value relative to gold. While gold was basically going sideways, it went down. And it set up a parallel price channel. It's probably one of the best price tools you could find is parallel channel analysis. And look at that last pullback in this year, which was from hitting that channel at $26, no, $24, top of the channel, the third hit on top of the channel, right there. Yeah. You pull back into that was early this year. You pull back down and then you shot up. And in early this year, when gold got back over 2000 again, silver shot up to 26 on a weekly close. Yeah, that if you look to your left, you'll see there was a prior peak over there at 26 as well, back in March of 2022. Okay, so you're outside the parallel channel, which is positive. And then you went into that arm wrestling process from March to October of this year, where just like gold, it was arm wrestling. It wasn't a collapse this time. And then you exploded outside that wedge. And look where you peaked on a weekly close 3 weeks ago. Basically just short of $26. Okay, so now the price guys have a level. And frankly, you should pay attention to it, because when you go through there, you're going to rip their heads off. You had this repeated selling at 26, 26, 26. And they got a pullback 2 weeks ago that sat down on top of that wedge, and then you shot up last week. This is last week's close, by the way. We're a little bit higher than that right now. We're 2450 level instead of 2415. And also gold, instead of 2035, where it was last week's close, is now 2055. Okay. But anyway, this is what the price action looks like now. It's lagged to momentum, which has already shifted positive, but it's even price is saying, okay, you know, I'm doing okay. Don't be panicked by the recent sell-off. And I suspect in the case of silver, the key there is you get it over 26 and you're gonna turn some heads. Now, these are real interesting charts, I think. These are spread charts, relative performance. And back in the 2020 explosion on the left side of that chart, what this shows is silver price per ounce expressed as a percent of an ounce of gold. Back then, silver was less than 1% the price of gold. It was 0.9% of 1% of the price of gold. And during that summer explosion and into early 21, in fact, silver went from 0.9% to over 1.5%. That's a huge percent gain. No, it's not just a 0.5%. It's like buying a stock at $90 and having it go to 150. Silver vastly outperformed gold during that surge. But then during the process from 2021 through recently, as the market has corrected sideways for gold, down for silver on the price charts that we just looked at, this spread has also gone down. So silver's lost relative performance to gold, but it's set up a structure here that you can draw fairly clearly. Multi-point downtrend, very gradual. By the way, notice silver hasn't gone back to its relative performance lows it saw in 2020. It's pulled back to less than 1.2%. Right now, it's about 1.19%. What we're saying here, these are monthly closes. If you close a month with the price of silver is about 1.24% of the price of gold, I'm going to blow out that trend line, and I'm going to take out that last high. So like 0.5% higher relative performance shift favoring silver will break out of this couple-year structure, signaling what? Silver's going to beat gold again. Now, in the below is a chart, similar action by the miners. They also outperformed gold in that 2020 to late 2020 surge. From 1.4 something percent of GDX is the price of gold, up to 2.2% price of gold. And then they entered this protracted decline. In the process, during the couple of years, they gave back a lot of their relative performance, and they developed a parallel downtrend channel. Well, actually, it sort of broke out the end of November. And right now, it's still outside. In fact, that last tick, which is a marginal downtick, you can uptick that, because that's not a monthly close. That was a week ago. GDX is outperforming gold. You'll notice today, like gold's up percent or something, and GDX up like 3. We have something like that. Also, we notice in the big blue chip miners like Newmont and Barrick Gold, a sudden energy in those stocks, far more than you see in gold day to day recently. I think it's indication that there's some large portfolio managers out there concerned about, hey, you know, where do I need to be? What sector's performing good? And if you look at the gold miners, they're definitely oversold. They're very cheap. It's a very small sector too. And they're starting to perform fairly well. But anyway, the thing about the spread charts is this. If you go back and look at the bull markets in gold in 1979, a year before it surged from like $400, I don't have the chart here, but there had been a multi-year bull market in gold. 79, it went vertical. Made its gains literally several years, peaked in January of 1980 at 850. Silver during that time shifted into outperformance mode, again, already in an aged bull market for both of them. But silver had been sort of sloppy in terms of its performance. Suddenly grew a backbone and went vertical, went from like $20 to 50. Gold went up nice percentages at that point, but silver vastly beat gold. And the spread chart told you back then, just like it's possibly going to tell us now. Same thing happened in 2010. We've been going up for like a decade in gold, and suddenly you started to go vertical. And silver really went vertical at that point. And it also shifted into a spread outperformance mode. When did that occur? In the last year of the bull market. So if you see these two charts, the miners versus gold, silver versus gold, shift into outperformance mode, it's not only an indication that they're going to beat gold going forward, which they haven't done for the last 2 years, but probably it's going to be coincident with verticality in the markets, those markets. So it's very important to watch those spreads.
I totally agree. It's weird that word spread, because we use the word ratio, but essentially, guys, people who aren't familiar with this terminology, spread ratio is the same. We use it all the time.
You could do it the other way too. Yeah.
Yes.
Yeah.
And this is what people have to understand. This is, if gold's breaking out and has been breaking out, going upwards, the U.S. equities, if normally, even if people look at them and they see going up, there's a high likelihood that the U.S. equities are just either muddling sideways and they're at risk of rug pulls. It's like normally they could get a rug pull, and or they're not. Like, I did a Russell chart pricing gold. Man, the Russell has been decimated by gold since the peak in 2001, and even since 2018. You can even make a case that gold's in a bull market. Well, I think you called it you said maybe 2016, but even in 2019, gold has been in the bull era versus U.S. small cap stocks. That's how bad.
Oh yeah,
it is.
Yeah. Also, if you just look, if you're a believer in the S&P and the NASDAQ charts, again, they're very limited. You can take about 5 symbols out of each, and it constitutes for the S&P about 20-some%, and on NASDAQ about 40%. Okay. They call it the NASDAQ 100 and the S&P 500, but really it's 5 stocks or so. If you took them out, you wouldn't see price charts like they look like now. But contrast what you just said, Russell 2000. Pump up a chart, Russell 2000, compare it to an S&P price chart, see if you see what you see on the S&P price chart. You don't. No, it's nowhere near the new highs. So reality is not what you see on the S&P or NASDAQ charts.
Right. I'll just mention at that point, Michael, there'll be maybe some people who are listening who are cryptocurrency fans as well. And it's exactly the same situation with cryptocurrency, because Bitcoin and Ethereum have led the market over the last year or so, sort of 18 months. If you strip out the top 2 or the top 10, and there are a couple of charts that you can get quite easily. One's called Others, I think. It's listed as Others, but it's basically the crypto market minus the top 10 market cap cryptocurrencies. And if you look at those charts, they don't look anything like the overall crypto total market cap, because crypto total market cap, a bit like the S&P, has been breaking out and looking pretty good. But strip out those top 2, 5, 10 leaders, then the rest of the market, which by the way is made up of thousands of cryptocurrencies, I think somewhere between, I've lost count, but probably around 3, 4, 5,000 cryptocurrencies, they do not look anywhere near as bullish. They haven't broken out. So it's a parallel situation to the stock markets. You're getting a select few that are just pretty much kind of distorting the picture and giving a little bit of a false sense of security there. It does warrant caution, and it warrants, that kind of attention, and bringing that to people's attention is important, because if you don't have the underlying strength and the breadth in the market, then to me anyway, it's not healthy.
Correct. We do reports every 2 weeks on Bitcoin and Ethereum. That's the only thing we look at in that arena, and we've done it since the future started trading in late 2017. We got months ago at much lower price levels after that huge drop that we got bearish in the mid 50,000s. It hit a high at 70,000. But back in 2022, we get bearish, we get bullish again months ago. Now we had a rally, but we thought there would be problems. We caught up into the mid 30,000s. We said there's going to be a problem at 45,000 and below 50,000, sort of ballpark zone. Well, Bitcoin stuck its nose above 45,000 a couple of weeks ago. It got whacked back down last week. And it's laboring below there. So there's some problems up there. There's resistance. And the question now is, Bitcoin used to be moving sort of with gold a couple of years ago. Then it divorced itself and started to move more like the S&P. And in fact, right now, you could argue that, well, the recent surge in Bitcoin is coincident with the S&P surge. Okay. But given that it's the big picture to us is a little confusing now because we did hit that resistance. So we're satisfied with the move we just had. We said take profits, okay? And the question, we don't mean it's a bear situation, but it's questionable here. The question is it going to continue to have problems here and slip back through some levels you don't want to slip through, in which case it goes down more seriously? Or is it just going to spin its wheels below that resistance? So the question is sort of a fundamental one. A lot of the people buying Bitcoin or Ethereum are buying an alternative to the paper money unit the government issues. Also gives them some privacy, they hope. We're not sure about that even. But it could be that there's a growing sentiment shift toward non-governmental money on the perception, the correct perception, like Gunlock said last week, they're going to monetize again. They're going to have to go big soft, meaning the value, the underlying value of your money is going to decay again. In which case, do you want to have your money in dollars, or do you want to have it in gold and or maybe Bitcoin? So it's possible maybe Bitcoin could rejoin gold in terms of being an alternative. And we're open to the possibility that it stays linked with the stock market, which it seems to have done over the last year or so. In fact, you could almost week by week. Now, recently, it started to wobble a bit, Bitcoin. The question is that an indication of divorce from the stock market, or maybe the stock market's going to start to wobble too? But anyway, so it's sort of questionable. But longer term, fundamentally, you have to ask yourself that question. Could it be there's going to be a movement of sentiment?
Also something you're talking about spread charts there, Michael, or as we would sort of look at ratio charts, and looking at the ratio chart between Bitcoin and gold is pretty fascinating, because that might sort of explain part of the reason why Bitcoin is sort of spinning its wheels, getting a bit stuck in the mud where it is at the moment, because that particular spread chart is hitting an interesting point of resistance on many technical indicators. So effectively, Bitcoin is wanting to break out versus gold here. It's had a good run versus gold, and it has been outperforming gold for a period of time, actually, since it hit its low, since Bitcoin hit its low. Mm-hmm. But it's now up against one of those clearly identifiable levels of resistance. So either it's a fascinating situation, because if Bitcoin and gold are an anti-fiat play, then they can both rise. But if Bitcoin is rising faster than gold, then that's more attractive to an investor. But if of course,
but it's hitting resistance now, you say, yeah,
okay. It is hitting resistance. So if it gets rejected at that resistance, then that's not particularly good for Bitcoin, given its questionable position. But also, it could be extremely good news for gold.
Well, I did a gold chart and Bitcoin chart, and when gold breaks out, Bitcoin hibernates. Like when gold broke out in June of 2019, that was the actual resistance of Bitcoin hitting the wall, like just below its previous highs, and it went sideways and down. Gold shot up, and as soon as gold peaked, that a few months later, that's when the Bitcoin broke out, and it did that. I had that chart on Twitter somewhere, and I was fascinated that I don't know, like if that's going to reproduce again. It's like such a small sampling, but I'm looking at gold now. So if gold has broken out, it's very possible right now that Bitcoin just hibernates until gold finishes pricing in the destruction of purchasing power required to save the U.S. equities, right? It's gold's pricing in advance, Michael. What you just said, the softening, it's doing it in advance. And when people hear about all that softening, I have to go in gold. Sorry, guys.
So a time scale for that sort of initial move, if that's the roadmap that we've got, the way I would see that playing out is that if gold's breakout is confirmed, and if we get a quarterly close reasonably clearly above $2,000, that's also a strong signal there as well. So if we start to get clear confirmation that gold has made a clear breakout here, I've got a roadmap in mind of sort of 6 to 12 months of precious metals doing exceedingly well, and that could, as you say, Pat, could coincide with a 6 to 12 month hibernation for cryptocurrencies or Bitcoin, and then gold hitting an interim target of the upper 2000s, maybe spiking up to the 3000 area. That's the way I would see it, and then a pullback for precious metals, and that would give perhaps Bitcoin and cryptocurrencies their sort of foot in the door to get their rally going. So that's a possible roadmap, and of course there are a number of possible scenarios for the way this plays out. But as I say, if gold does get that breakout, then that's quite a high likelihood scenario I would see there. Don't know what your thoughts are on that, Michael, but you know, gold breaking out, cryptocurrencies sort of going on the back foot for a while. Certainly a possibility.
Yeah, it's possible that they've had their run, and the fact that you identify spread resistance the same time we identify momentum resistance based on price, not a price chart resistance, but momentum of price. Both hit ceilings at the same time. It argues the case that for the near term anyway, if you've been long Bitcoin, fine, maybe you should take profits and step aside for a while. I don't know that there's going to be a sharp drop, but there could be wheel spinning, in which case it's a waste of time, maybe painful even. But as far as the gold breakout, that's a price-based thing. Our momentum stuff says no, you're free to go. Price is almost always lagged to what momentum says, thumbs up, and then price maybe a month, 2 months later says, oh, okay, I'm joining in. I would really watch the spread charts though, silver and the miners versus gold, because if they crack through those structures that we showed on the spreads, basically that's a blanket thumbs up. I mean, if you doubt gold, you're wrong. You should be buying the monetary metals with an emphasis on the baby markets, silver and the miners, because they'll vastly beat gold. And we know that in the past. The periods of time, particularly late in a bull market. This is 8-year-old gold bull right now. Remember, we started from 1,050. We're now double. You go back and look at the prior bull markets in gold over the last 50 years, 8-fold moves. So, we're talking $8,000 gold just to replicate the ratio of those couple other bull market moves that occurred since gold was legalized. And we've got fundamentals now that are far more dynamic than at any point in the last 50 years for all markets, especially monetary metals. So you break those spreads out on silver, gold, miners gold. It's seatbelt time.
Right.
Seatbelt time. There you go, Pat. That's the title for the podcast.
Yeah, strap in your seatbelt. Well, it's the weight of evidence, and that's why we love having you on, Michael, because you're that momentum specialist. I highly recommend anybody that's not subscribed to Michael's newsletter there. Tell everybody where they could find your work, Michael, please.
Our site is olivermsa.com, MSA for Momentum Structural Analysis. You'll find who we are on there. Click on my picture, and there's an email address. Click on it. Request some sample reports. Be happy to send them. We cover all 4 major markets: debt markets, foreign exchange, commodities, emphasis on monetary metals, and stock markets. And you don't just watch U.S. stock market either. Last minute comment: watch China. Shanghai has a good linkage to the S&P, not in terms of dimensionality, but in terms of directional swings. It's breaking through massive annual momentum support this month. It's deviated from the S&P. You're not going to do that and us go up. China and us are 46% of the world economy. They're not going south and us go up. Okay. Anyway, something else to look at.
Yeah, 2024 is going to be a fascinating ride, I think, Michael. And we'll look forward to having you back on the show at various points during 2024 because, times are getting very, very interesting indeed, to put it mildly. Thank you very much for joining us on the show today, Michael. Really appreciate your time talking to us and talking to the audience here. And great. Really enjoyed that. Pat, have you got anything to add before we say final farewell?
No, that's it, Mike. Always a pleasure, and can't wait to see you on the other side of this.
Always fun to be on bad charts.
All right, man. And North Star, Michael. North Star bad charts.
North Star bad charts. Okay.
Bye, Mike. Thanks, Mike.
Cheers, Michael. Bye-bye.